What if I told you that the biggest mistake traders make is not losing money, but chasing the wrong dream? Every day, thousands of people open their charts, their hearts beating with hope, thinking they are one strategy away from financial freedom. They look for the perfect setup, the magic indicator, the secret YouTube method that will make them rich overnight. And for a brief moment, they win. The dopamine rush kicks in. They screenshot the profit and send it to their friends. But the next day, or the next week, reality strikes. That same method fails, the losses pile up, and the account begins to bleed. This is not failure. This is the illusion of success. Welcome to Trading Psychology Stick, where we strip away the fantasies and reveal what actually works in the markets. Quick disclaimer, nothing here is financial advice. This is education about the psychology and mathematics of trading, your money, your decisions, your responsibility. Now imagine two doors. Behind the first door is consistency, slow, steady profits that compound over months and years. Behind the second door is excitement, wild swings, doubling your account in a week and then losing it all the next. Most traders think they want the first door, but their actions betray them. They run headfirst into the second, blinded by the glitter of quick riches. And the market? The market punishes them ruthlessly. Here's what the gurus selling courses won't tell you. Trading is not about predicting the future. It's not about calling tops and bottoms, not about being smarter than everyone else. It's about building a method, your method, where probability bends in your favor, where losses are controlled and wins, when they come, outweigh them by design. This is not gambling. This is not guessing. This is mathematics woven into discipline, psychology anchored in reality. The story of price action, the story of expectancy, the story of risk and reward, it is not glamorous. It won't make you a millionaire in a week, but it will show you how the greatest traders in history, from Richard Dennis, who turned $200 into $400 million, to Rakesh Jhunjhunwala, who built a fortune with only 40% accuracy, created empires not through luck, but through systems that worked over time. This video is not for those chasing shortcuts. It's for those who want to understand the architecture of success in trading. Over the next chapters, we'll walk through the illusions that keep you stuck, the coin toss that reveals the secret of expectancy, the 95% trap that swallows new traders, and the rules that transform randomness into an edge. By the end, you won't just know about price action. You'll see the truth behind it, the kind of truth that forces you to choose, remain a dreamer, or become a trader. Chapter 1. The Two Roads and the 95% Trap. Every trader begins at the same crossroads. On one side lies the promise of stability, modest but steady profits, risk managed carefully, a curve that grows like a small plant watered daily. On the other side, a dazzling path of fireworks, the chance to double your account overnight, the thrill of being right against the market, the intoxicating dream of riches pouring in with a few clicks. Most people swear they want the first road. They nod their heads when asked. They say, "Of course, I want consistent income." But their hands betray them. They chase signals, they gamble bigger, they enter trades without stops, all in pursuit of the second road, the one lined with illusions. You see it every day in trading communities. Screenshots of profits posted like trophies, captions screaming, plus 300% in a single trade. What you don't see are the accounts that vanish, the traders who stop posting when losses wipe out weeks, even months of effort. Social media only shows the champagne moments, never the hangovers. And so, the dream of getting rich quick seduces newcomers into believing that stability is boring, that slow growth is not enough. Here's a statistic that should terrify you. 95% of traders lose money. Some argue it's 70, some say 90, but the truth remains. Most fail, not because they are stupid, not because they are lazy, but because they walk straight into the same trap. What is this trap exactly? It's the addiction to methods over systems. It's believing that success comes from finding the perfect indicator, the guru's secret setup, the magical course that guarantees instant profits. It's the endless cycle of strategy hopping, chasing the next big thing, without ever stopping to ask the only question that matters. Does this method have positive expectancy? Let me paint you a picture that might feel uncomfortably familiar. A new trader discovers Forex, stocks, or crypto. They open YouTube, type best trading strategy, and instantly drown in videos promising 90% accuracy. They buy the course, they copy the template, they feel unstoppable. Then reality hits like a sledgehammer. Losses come, emotions surge, the system breaks. Instead of asking, what does the math say, they blame the method and search for another. Weeks turn to months, months to years, and their account shrinks while their hope fades. Statistics from retail brokerages tell the same brutal story. Look closely at their disclosures. 70% of retail accounts lose money trading CFDs. Some report 80% or more. These aren't empty warnings. They are reflections of the trap. The majority trade without structure, without rules, without risk management. They may have moments of brilliance, fleeting profits that feel like validation. But without expectancy, brilliance fades into dust. Meanwhile, the professionals, the 5% who survive, do something radically different. They don't worship at the altar of accuracy. They don't measure themselves by how many trades they win. They measure expectancy, they test, they refine, they accept losses as a cost of doing business, not as proof of failure. Edsay Coda, one of the legendary trend followers, put it bluntly, win or lose, everybody gets what they want from the market. And what most people want deep down is excitement, not consistency. They crave the rush of being right, the thrill of doubling an account, the validation of posting profits online. But the market is a mirror, and it gives them exactly what they desire: short-term excitement, long-term ruin. Think of Richard Dennis and his turtle traders experiment. He took people with no trading experience, some were actors, others were accountants, and taught them a simple trend-following system. Not magic, not complex, just rules, discipline, expectancy. Their results didn't explode overnight. In fact, many had losing months. But over years, they carved fortunes out of market chaos. Before we dive deeper, I want you to do something. Pause this video for 10 seconds and ask yourself honestly, which road are your current habits revealing? Not which one you want, but which one your last 20 trades actually show. Go ahead, I'll wait. Welcome back. If you're honest, you might have just realized something uncomfortable. And that discomfort, that's the beginning of change. Because recognizing the gap between what we say we want and what we actually do is the first step toward bridging it. Chapter 2. The Prediction, Illusion and Price, Action Paradox. If there is one addiction stronger than quick profits, it is the obsession with prediction. From the moment a trader opens a chart, their mind starts whispering, where will the market go next? Up or down? Should I buy now? Should I sell before it drops? The brain craves certainty, because uncertainty feels like chaos. And so, millions of traders search for the crystal ball, an indicator, a guru, a foolproof method that promises to forecast tomorrow's candle with surgical precision. But let me share something that changed my entire perspective on trading. In 1998, long-term capital management collapsed. This wasn't some amateur operation. They had Nobel Prize winners in economics, literally the smartest financial minds on the planet, running mathematical models so complex they required supercomputers. They believed they had solved the market. Within 2 years, they lost $4.6 billion and nearly triggered a global financial crisis. Their mistake? They believed prediction was possible. Now you might think, but that was decades ago. Surely we've gotten better, have we? In 2020, oil futures went negative for the first time in history, minus $37 per barrel. Every prediction model on Earth failed to see it coming. Every single one. This is where price action enters the conversation. Price action is often marketed as the solution to the prediction problem. Learn to read the candlesticks, and you'll know exactly what comes next, they say. The phrase rolls off the tongue like a secret password, a badge of honor in trading circles. Say you're a price action trader, and suddenly you sound wiser, purer, closer to the truth. No messy indicators, no lagging signals, just pure market language. But here's the paradox that nobody wants to admit. While price action promises clarity, most traders use it to feed the same illusions that destroy them. They see a pin bar and declare, the market will reverse. They spot a head and shoulders pattern and announce, a collapse is coming. And when it works once, they feel like prophets. When it fails, they shrug and chase the next pattern. Let me tell you the naked truth. Price action is not magic. It's not prophecy. It's simply the raw language of the market. At its core, price action is nothing more than the collective behavior of buyers and sellers captured on a chart. Every bar, every wick, every close is a story of imbalance. Demand overwhelming supply, or supply crushing demand. That's it. Nothing more, nothing less. A bullish engulfing candle doesn't guarantee the next bar will skyrocket. It only tells you that at that moment, buyers pushed harder than sellers. The real power of price action is not in prediction, it's in context. Think of it like learning to read body language. A smile might mean happiness, or it might mean nervousness, depending on the situation. The gesture itself doesn't predict the next move, but combined with context, it gives you information you can use. Here's an experiment that will blow your mind. Researchers at MIT created a random chart using coin flips. Heads, the price goes up. Tails, it goes down. They showed this random chart to professional traders and asked them to identify patterns. Every single trader found head and shoulders, triangles, support, and resistance levels. Patterns in pure randomness. Think about that. Our brains are pattern recognition machines, and they'll find patterns even where none exist. A quantitative analyst once showed me their testing results. They had programmed computers to identify every classic price action pattern across 20 years of data. Head and shoulders, pin bars, engulfing candles, all of them. Then they measured the win rates. Want to know what they found? Most patterns performed no better than random chance. The head and shoulders, that holy grail of reversal patterns, succeeded 52% of the time, basically a coin flip with extra steps. But here's where it gets interesting. When they added context, when they combined patterns with trend direction, support and resistance levels, and volume, suddenly the edge appeared. Not huge, maybe 55 to 60%, but enough to build a system around. The pattern alone was meaningless. The context made it profitable. The more traders analyze, the more paralyzed they become. They zoom into the 1-minute chart, then zoom out to the daily, drawing lines everywhere, until their chart looks like a spider's web of confusion. They convince themselves that more analysis equals more certainty. But the truth is the opposite. The more you analyze without rules, the more you find conflicting signals, and the more you hesitate. This is analysis paralysis, death by overthinking. What if I told you there's a trader who became a billionaire with less than 40% accuracy? Sounds impossible, right? Yet Rakesh Jhunjhunwala did exactly that. He was wrong more often than right. But when he was right, his wins were 3 times, 4 times, sometimes 10 times his losses. He didn't predict, he positioned. Quick challenge for you. Think of your last losing trade. Now, be honest. Did you lose because you failed to predict the market, or because you didn't have a plan for being wrong? Drop your answer in the comments. I'm genuinely curious what you'll discover about yourself. Chapter 3. The Coin Toss Secret of Expectancy. Close your charts for a moment. Forget candlesticks, forget trend lines, forget the endless debate about indicators versus naked charts. Let's play a game that will revolutionize how you think about trading forever. I hand you a coin. Here are the rules. Heads, you win $1.50. Tails, you lose $1. Would you play? At first, you hesitate. If you only have a single dollar to your name, the thought of losing it feels unbearable. But now imagine you have $100 and you can flip this coin 100 times. What happens then? Let's do the math together, because this is where trading becomes beautiful. Out of 100 flips, roughly 50 will land on heads, 50 on tails. 50 wins at $1, 50 each equals $75. 50 losses at $1 each equals $50. Subtract, and you're left with $25 profit. Nothing magical, nothing glamorous, just the cold, hard math of expectancy. This is the beating heart of professional trading. It is not about being right on every flip. It is not about finding the coin that always lands on heads. It is about structuring the game so that when you lose small, and when you win bigger. Over time, that difference compounds into wealth. The formula is almost embarrassingly simple. Win percentage times average win minus loss percentage times average loss. This equation is the law every successful trader bows to, whether they realize it or not. Richard Dennis understood this at a molecular level. The man who turned $200 into $400 million did not care about predicting the next tick. He cared about expectancy. His famous turtle traders sometimes had win rates as low as 5%. 5%. Let that sink in. 95 trades out of 100. Wrong. 5 trades, right? And yet, they still built fortunes. How is that possible? Because when they won, their wins were 10 times, 20 times, sometimes 50 times their losses. That was enough to tilt the entire game in their favor. They weren't prophets, they were mathematicians disguised as traders. Now, let's sharpen the numbers until they cut through every illusion. The formula for expectancy gives us the break-even point, the exact win rate you need to not lose money, depending on your risk to reward ratio. Start with the most basic case. Risk $1 to win $1. That's a 1-to-1 ratio. To break even, you must win at least 50% of the time. Any less, and you're slowly bleeding money. This is why so many traders struggle. Their win rate hovers below that invisible 50% line, and they can't figure out why their account keeps shrinking. But watch what happens when we adjust the game. Suppose you risk $1 to win $1.50, a 1 to 1.5 ratio. Suddenly, the math bends in your favor. You no longer need to win half your trades. You only need to win 40%. That means even if you're wrong 6 times out of 10, you still come out ahead. Push it further. Risk $1 to win $2, a 1 to 2 ratio. Now your break-even win rate drops to just 33%. You can be wrong 2 out of 3 times and still make money. Let me repeat that because it's so important. You can fail 67% of the time and still build wealth. This is the magic of asymmetric reward. Van K. Tharp, one of the greatest trading psychologists, built his entire career on teaching this concept. He showed traders that the obsession with accuracy, the desperate need to be right 70%, 80% of the time, is a psychological trap. Accuracy without reward is meaningless. A 70% win rate means nothing if your winners are tiny and your losers are massive. Here's a mental model that will serve you forever. Think of casinos. They don't need to win every spin of the roulette wheel. The house edge on European roulette is just 2.7%. That tiny edge, multiplied over millions of spins, builds billion-dollar empires. Your trading is no different. You are the casino, not the gambler. Your edge is expectancy. Now here's where most traders stumble catastrophically. They flip the coin 10 times, lose 7, and panic. They forget that probability only reveals itself in large numbers. They forget that short-term randomness doesn't invalidate long-term expectancy. They quit before the edge has time to show itself. Or worse, they double down recklessly, desperate to make it back, and burn out their account in a blaze of emotion. Take a moment and calculate this for yourself. If you risk $100 per trade and target $200 with a 40% win rate, what's your expectancy? 40% times 200 equals 80. 60% times 100 equals 60. 80 minus 60 equals $20. Positive expectancy per trade. Over 100 trades, that's $2,000. Not from being right most of the time, but from structuring the game correctly. Chapter 4. The Survival Mathematics. Risk and Anchors. You can have the best system in the world, a method tested across thousands of trades, a beautiful expectancy curve tilted in your favor, and still lose everything. How? By ignoring the single most important principle in trading, risk per trade. Risk is the heartbeat of survival. Without controlling it, you are a gambler on borrowed time. With it, you become nearly indestructible. Let me make this crystal clear. Defining risk per trade means setting a maximum percentage of your account you are willing to lose on a single position. For professionals, that number is small, usually 1 to 2%. To amateurs, it feels laughable. How can I make big money risking so little? They scoff. But that's exactly why amateurs disappear while professionals endure. Let's do some sobering math together. If you risk 10% of your account per trade, 10 losing trades in a row can wipe you out. And before you say that will never happen, let me tell you, losing streaks are not bad luck. They're probability. Even with a system that wins 60% of the time, you can face streaks of 10 or 15 consecutive losses. Now shrink that risk to 1% per trade. Even if you suffer 10 straight losses, your account is only down 10%. Painful, yes, but survivable. More importantly, recoverable. At 10% drawdown, you need about 11% to break even. At 50% drawdown, you need 100%. At 90% drawdown, you need 900%. That is the mathematics of destruction most traders ignore until it's too late. Rakesh Jhunjhunwala, often called the Warren Buffett of India, understood this principle at a deep level. He wasn't right all the time, far from it. His accuracy hovered around 40%. But he defined his risk, sized his positions accordingly, and managed his losers so they never drowned his winners. That discipline turned him into a billionaire. Risk per trade also shapes your psychology in ways you can't imagine until you experience it. When you know the worst-case scenario is a tiny fraction of your account, you stop panicking. You stop sweating every tick. You stop obsessing over being right. You can think clearly, execute calmly, and let your system work. But knowing this intellectually and doing it emotionally are two different battles. When that trade is going your way and every cell in your body screams to increase size, to go all in just this once, remember this. Every blown account started with someone breaking their risk rules just once. Every single one. This is where anchors come in. In trading, emotions whisper dangerous lies. Greed says, hold on, it will go higher. Fear says, get out now before you lose it all. Hope says, remove that stop loss, the market will come back. These voices have destroyed more accounts than all the bad strategies combined. That is why you need anchors. Mechanical, non-negotiable points that protect you from yourself. Those anchors are stop loss and take profit. A stop loss is not a suggestion. It is your shield. It defines the exact moment you accept, I was wrong on this trade, and I'm willing to pay this predetermined cost. Too many traders treat stop losses like decorations, moving them wider when price approaches, convincing themselves that the market will come back. It rarely does. Without a stop, your small loss can become catastrophic. With a stop, your damage is controlled, your account preserved for the next opportunity. I once watched a trader turn a $50 loss into a $5,000 disaster. He kept moving his stop, kept adding to the position, kept believing the market would reverse. It didn't. One trade, 100 times his original risk, account destroyed, all because he couldn't accept a small loss. On the other side is take profit. This is not about greed. It's about discipline. Your take profit defines the reward side of your risk to reward ratio. If you risk $1, your take profit at $2 enforces a 1-to-2 ratio. Over dozens of trades, that ratio ensures your expectancy stays positive even when your win rate dips. George Soros once said, "It's not whether you're right or wrong, but how much money you make when you're right and how much you lose when you're wrong." That wisdom is encoded into every stop loss and take profit level. Think of these anchors like seatbelts in a car. Most of the time, you don't need them. The drive is smooth, uneventful. But when the crash comes, and it will, they save your life. Traders who refuse to use stops eventually face a collision they cannot survive. Traders who ignore take-profit targets end up watching winning trades turn to dust because they never locked in their asymmetric edge. Here's what changed my trading forever. Once I fixed my stops and targets before entering any trade, I stopped obsessing over every tick. The market could dance however it wanted, and I remained calm, anchored by rules I had already set. My job was no longer to predict, it was to execute. The psychological freedom this creates is indescribable. Take this challenge right now. Calculate 1% of your current trading capital. That's your maximum risk per trade for the next month. No exceptions. No matter how perfect the setup looks, no matter how certain you feel, 1% maximum. Try it for 30 days and watch how your psychology transforms. Every losing trader shares one thing in common: chaos. They enter trades on impulse, close them out of fear, and justify every decision with words like intuition or gut feeling. But markets are not conquered by chaos. They are conquered by rules. Without rules, you don't have a method. You have gambling dressed in analysis. With rules, you transform randomness into probability. Let me tell you about two traders I knew personally. Both looked at the same EUR/USD chart on the same morning. The first saw a bullish engulfing candle and thought, "This must go up." He entered immediately, heart pounding, hoping for profit. No stop loss because he was sure. No target because he wanted to let it run. The second trader also saw the engulfing candle, but he had rules. His rule said only trade engulfing candles at support after a pullback in the direction of the daily trend, with a stop 2 pips below the low and a target twice the risk. The pattern matched. He entered. The market dropped 50 pips. The first trader held on, averaging down twice, and finally closed at a 300 pip loss. The second trader was stopped out for a 20 pip loss and moved on. One trade, 2 approaches. One survived, one got destroyed. The difference wasn't the pattern, it was the rules. Paul Tudor Jones said it best. Don't focus on making money, focus on protecting what you have. That mindset flows directly into rules. Rules strip away emotion and force you to play the game of expectancy. Think about professional pilots for a moment. They don't rely on gut instinct when a storm hits. They follow checklists, protocols, procedures tested over decades. That's why flying is the safest form of travel. Your trading should be no different. Your rules are your checklist. Without them, you crash. With them, you survive turbulence. Here's the beauty most traders never discover. Rules don't kill freedom, they create it. Once you know your system, you are free from doubt, free from second guessing, free from paralysis. You stop obsessing over prediction and start executing your plan. But rules don't appear out of thin air. They must be tested, verified, proven. And that's where backtesting comes in, the process that separates wishful thinking from statistical reality. Every trader has ideas, but ideas don't pay the bills. Numbers do, and the only way to know if your idea has teeth is to test it, not once, not twice, but hundreds of times. That process is called backtesting, the trader's truth detector. Backtesting is brutally honest. It doesn't care about your opinions, your confidence, or your gut feeling. It only cares about outcomes. You feed it your rules, your setups, your stop loss, and take profit logic, and then you let history tell you the story. If your system holds up across hundreds or thousands of trades, congratulations. You've built something with positive expectancy. If not, no amount of hope will turn it into gold. Let me share something that most retail traders don't know. Prop firms and hedge funds never risk real money on untested strategies. Never. Before they risk a single dollar, they run simulations on years of market data. They demand statistical proof. What is the win rate? What is the average risk to reward ratio? What is the maximum drawdown? How does it perform in trending versus ranging markets? Without that data, they don't trade, period. Yet retail traders skip this step entirely. They take a method from YouTube, try it live with real money, and when it fails, they blame the strategy and move on. They confuse testing with trading, practice with performance. Backtesting doesn't just reveal whether a system works. It reveals its personality. Maybe your method performs beautifully in trending markets, but collapses in ranges. These insights aren't setbacks. They're refinements. Every failed test is a gift. It shows you where to adjust, where to adapt, where to strengthen. But here's the critical key. Backtesting only matters if you follow clear, unchanging rules. You can't change your stop loss halfway through because this time feels different. You must treat every historical trade as if it were live, with discipline and consistency. And once you have those statistics, something magical happens. Doubt begins to fade. When you know your system has a 40% win rate with a 1 to 2 risk to reward ratio, you stop panicking after 3 losses in a row. You know the math is still in your favor. This is why professionals survive and amateurs don't. Professionals respect the numbers. Amateurs respect their feelings. In the long run, numbers always win. Quick reality check. Have you ever backtested a strategy over at least 100 trades? If not, you're not trading, you're gambling. Drop a comment with the number of trades you've backtested. If it's 0, commit to testing your next idea over 100 historical trades before risking a single dollar of real money. Chapter 6. Turning randomness into edge. At first glance, markets look like chaos. Prices rise, fall, spike, crash, seemingly at random. For beginners, it feels like trying to predict which way a leaf will blow in a hurricane. But professionals know a secret that changes everything. You don't need to control the chaos. You only need to tilt the odds. That tilt is what we call an edge. Think back to our coin toss game. 50-50 odds. Pure randomness. But the moment you attach asymmetric payouts, risking $1 to make $1.50 or $2, the game shifts. Suddenly, even with less than half the flips landing in your favor, you walk away with profit. That's how casinos thrive. They don't win every spin of the roulette wheel. They don't need to. They care about the edge. Over thousands of plays, the house always wins. Trading is no different. Your job is not to eliminate randomness, but to structure your system so that randomness bends in your favor. You do this by stacking filters. One rule might give you 50-50 odds on its own. Add another filter, and maybe you improve to 55-45. Add a third filter, and now you're at 60-40. Each layer nudges the probability until you have a small but consistent advantage. That advantage, repeated over hundreds of trades, compounds into wealth. This is exactly how the turtle traders made fortunes. Their win rate wasn't spectacular. Sometimes they lost far more trades than they won. I'm talking 30% win rates. 70% of their trades were losers, but their rules created an edge. They knew that when a big trend came, their system would catch it, and the profit from that one trend would erase dozens of small losses. They didn't fight randomness, they harnessed it. Here's the mistake that kills most traders. They test a rule, see it fail a few times, and abandon it. They forget that edges only reveal themselves in large numbers. A coin can land tails 10 times in a row, but that doesn't mean heads disappeared. Probability doesn't care about your last 10 trades. It cares about your next 1,000. Your mission is not to avoid losing trades. Let me repeat that because it's crucial. Your mission is not to avoid losing trades. Your mission is to build a framework where losses are expected, controlled, and insignificant compared to the wins. Randomness will always be there, swirling around like storm clouds. But your rules are the compass, and your edge is the North Star guiding you through the storm. Let me give you a mental model that changed how I see markets forever. Imagine you own a casino. Every day people come in and some win big. Does that stress you out? No, because you know that over thousands of games, your edge ensures profit. Now imagine your trading account is that casino. Every trade is a customer. Some will win against you. That's fine. Your edge ensures that over time, you're the one collecting. Once you understand this, you stop fearing losses. They become part of the design, not threats to your identity. And that shift leads us into the heart of trading mastery. Not just systems, not just rules, but the mindset that separates professionals from gamblers. Chapter 7. The Mindset Revolution. There comes a moment in every trader's journey where the charts blur, the indicators fade, and the strategies begin to feel like costumes. Beneath it all, one truth stands naked and undeniable. Trading is not a game of prediction, but a game of psychology. Your greatest enemy is not the market, it is yourself. At first, you believe the goal is to be right. You crave accuracy like a drug. You want the satisfaction of calling the top, the pride of nailing the bottom. Every win inflates your ego, every loss feels like a personal failure. You screenshot your winners and delete evidence of your losers. But this mindset is poison, because the market doesn't reward pride. It doesn't care how often you're right. It only cares about expectancy. The shift happens when you stop asking, was I right on this trade? And start asking, did I follow my rules? The outcome of any single trade becomes irrelevant. One trade cannot make you a winner or a loser. It is just a data point in a long series. What matters is whether you executed your edge with discipline. That's the only thing you control. Mark Douglas, author of Trading in the Zone, devoted his entire career to teaching this shift. He said, "The best traders have developed an edge, and they have learned to think in probabilities. They don't attach emotion to individual wins or losses. They understand that each trade is just one of many, like a single deal in an infinite deck of cards. Their identity is not tied to being right. It's tied to being consistent." This mindset also redefines loss completely. A losing trade is no longer a failure. It's a cost of doing business. Just as a restaurant pays for ingredients that might spoil, just as a store pays rent whether they make sales or not, a trader pays losses to the market. It's not a matter of if you'll lose, but whether your losses are smaller than your wins. Once you accept this, truly accept it, fear loosens its grip. I'll tell you the exact moment my trading transformed. I lost 5 trades in a row. Normally, I would have been devastated, questioning everything, maybe even revenge trading to make it back. But I had finally understood probability. I knew my system had a 40% win rate with a 1-to-2 risk-reward ratio. 5 losses in a row happens about 8% of the time with those numbers. It wasn't bad luck, it was math. I took the 6th trade with the same confidence as the first. It won, so did the next 2. By trade 10, I was profitable, not because I got lucky, but because I trusted the process. With the right mindset, you no longer sabotage yourself after a streak of losses. You no longer become reckless after a streak of wins. You remain steady, grounded in your system. You see the market not as a place to prove yourself, but as a place to apply your edge. Here's your challenge. For the next 10 trades, focus only on one metric. Did I follow my rules? Not profit, not win rate, just rule adherence. Score yourself. 10 trades, 10 opportunities to follow rules. Aim for 10 out of 10. If you can achieve that, profit becomes inevitable. Chapter 8. the endless refinement. A system, no matter how powerful, is never finished. Markets breathe, evolve, and change shape like living organisms. What works flawlessly in one season may stumble in another. This is why the greatest traders never stop refining. They don't abandon their systems at the first sign of weakness. They adapt them. Refinement is not about chasing perfection. It is about building resilience. The cycle is beautifully simple. Hypothesis, rules, backtest, adjust, retest. Every trader begins with an idea. That idea becomes rules, clear, repeatable criteria for entries and exits. Then comes the backtest, the proving ground where the system is tested against history. The numbers speak. Expectancy positive, negative, or neutral. If the edge is weak, you adjust. If it's strong, you refine further. Then you retest, over and over, until the system becomes sharp enough to endure real markets. Jesse Livermore, often called the greatest trader of the early 20th century, lived this cycle through triumph and tragedy. He made and lost fortunes multiple times. Each loss wasn't just money, it was feedback. He refined, adjusted, learned. His methods laid the foundation for trend, following principles still used today. His story is both a warning and a lesson. Systems are not static. Traders must evolve or perish. But here's what separates professionals from amateurs. Refinement doesn't mean strategy hopping. Many traders quit too soon. They test a method for a week, see losses, and run to another. They restart the cycle endlessly, never completing it. Professionals know that losses don't mean the system is broken. They mean the system is being tested. They stick to the process, making small adjustments instead of radical shifts. Let me share something most traders never realize. Every system has seasons. Your trend-following system might thrive in volatile markets, but struggle in quiet ranges. Your mean reversion strategy might print money in ranging markets, but bleed in strong trends. This isn't failure, it's personality. The key is knowing your system's personality and adjusting position sizing, not abandoning the system entirely. Refinement builds intimacy between trader and system. Over time, you learn its strengths and weaknesses like you know your own. You know when it thrives and when it struggles. You stop expecting it to win every trade and instead focus on how it performs over hundreds. This relationship creates confidence, and confidence is the antidote to fear. But refinement has one final requirement: humility. You must accept that you will never outgrow the need to improve. The moment you believe your system is perfect, the market will humble you. The cycle never ends, and that's actually a gift. Because with every cycle, you become sharper, stronger, more resilient. Quick assignment. Look at your last 20 trades. Group them by market condition: trending up, trending down, or ranging. Calculate your win rate in each condition. You'll likely discover your system has a preference. That's not a weakness to eliminate, it's a personality to understand. Use this knowledge to size positions accordingly. Strip away the hype, the marketing, the endless YouTube tutorials promising secret strategies, and what remains. Price action, at its core, is simply the market's heartbeat. Every candle, every wick, every close is nothing more than buyers and sellers pushing against each other in an endless tug of war. It is not prophecy. It is not certainty. It is raw data waiting to be structured into rules. The truth about price action is this: it only becomes powerful when combined with probability, risk management, and discipline. The best trading method is not hidden in a $3,000 course or whispered in a guru's private Telegram group. It is built brick by brick, from rules you can repeat, from losses you can control, from wins you can multiply. This is why Richard Dennis turned $200 into $400 million, why Rakesh Jhunjhunwala built a fortune with less than 50% accuracy, why George Soros focused not on being right, but on managing risk and reward. They didn't rely on illusions. They relied on probability, discipline, and rules. That is the real essence of trading. The market will test you every single day. It will seduce you with easy wins, then punish you with unexpected losses. It will whisper that this time is different, that rules don't apply, that you're special. But you're not special. None of us are. We're all just probability managers trying to tilt the odds in our favor. So the question now is not whether price action works. It always works because it is simply the market's language. The question is whether you can transform that language into a method. Can you build rules? Can you backtest? Can you define risk? Can you stick to the process through losses, through drawdowns, through the storms that drive 95% of traders out of the game? The truth is waiting. The edge is waiting, but only for those willing to trade the illusion of prediction for the discipline of probability. Only for those who can see past the noise and focus on what actually matters. Expectancy, risk management, discipline. These are not sexy. They don't make good Instagram posts, but they make millionaires. You've just walked through the illusions and the truths, through the traps that devour traders and the rules that set them free. Now the question is simple. What will you do with this knowledge? Because knowing is not enough. Reading about expectancy won't save your account. Nodding at the math of risk to reward won't stop you from blowing up if you keep ignoring it. Change only happens when you act. Here's your first challenge, and I want you to actually do this, not just think about it. Look at your current trading method and ask one brutal question. Does it have positive expectancy? Don't guess. Don't hope. Test it. Backtest at least 100 trades with clear rules. Write down the win rate, the average risk, the average reward. Calculate the expectancy using the formula I showed you. Win percentage times average win minus loss. Percentage times average loss. If the number is negative, stop trading it live immediately. Not tomorrow, not next week. Today. Second, define your risk per trade. No more than 1 to 2% of your capital on any single position. Write it into your rules, because this single decision will keep you alive long enough to let your edge compound. Remember, survival is the first victory. Third, embrace the mindset shift. From today forward, stop chasing perfection. Stop trying to be right on every trade. Focus instead on following your rules. After every trade, ask yourself, did I execute my system? Not, was I right? This one change will free you from the emotional roller coaster that kills consistency. I want to build a community of serious traders, not dreamers, not gamblers, but people committed to the process. If you're ready to transform your trading, comment below with your current win rate and risk to reward ratio. Be honest. If you don't know these numbers, comment calculating and go figure them out. Let's create accountability. Real traders sharing real numbers, supporting each other through the journey from the 95% to the 5%. If this message resonated, if you see yourself in these stories, share this with one person you know is struggling with trading. Not to show off, but to help them escape the same traps you've been stuck in. Sometimes the best gift you can give someone is the truth that saves them years of pain. Subscribe to Trading Psychology Stick if you're ready for more deep dives into trading psychology and method building. No fluff, no false promises, just the psychological and mathematical truths that separate professionals from amateurs. And most importantly, don't just consume this. Act on it. Start today. Open your trading journal. Document your next 10 trades with absolute honesty. Entry reason, stop loss, take profit, and whether you followed your rules. After 10 trades, calculate your expectancy. That number will tell you everything you need to know about your future as a trader. Because in the end, the market will always test you. It doesn't care about your dreams, your bills, or your ego. It only respects discipline, probability, and risk management. The question is not whether you'll face losses. You will. The question is whether you'll walk into the market blind or step in armed with rules, expectancy, and the discipline that separates the 5% from the 95%. The choice is yours. The knowledge is now yours. The only thing standing between you and consistent profitability is action. So, what are you waiting for? Your transformation begins with the very next trade you take. Make it count. Welcome to the 5%.